Welcome to the Deep Dive. If you feel like the economy is constantly pulling you in two different directions, you're definitely not alone.
Yeah.
It is mid-December 2025, and the market is just defined by this strange paradox.
It really is.
On one hand, you have this pure, unchecked technological excitement, mostly from AI, right? And on the other, this deep, grinding uncertainty.
And that's being fueled by lagging economic data and, central banks trying to figure out what to do next.
It's an environment where the signals are just so hard to read.
Oh, absolutely. We've had a massive data drought in the U.S. We're only just now expecting key releases like non-farm payrolls and the inflation numbers this week. And that vacuum of information, it really heightens the anxiety around what the global central banks are going to do.
So our mission today is to cut through all of that noise. We've
Yeah.
pulled together market reports, central bank forecasts, economic research on some really interesting leading indicators, and of course the latest corporate earnings.
Including from the big tech players.
Exactly. We are going to try and isolate the true underlying state of this split global economy and what those signals mean for your future planning.
Okay, so let's start right where the biggest questions are and the biggest valuations. The AI bubble debate.
Right.
We are seeing major financial institutions on completely different sides of the fence, and they're all drawing lessons from the dot-com era of 2001.
Okay, let's unpack the bullish argument first. Why are some of the major banks telling us this time is, genuinely different?
Well, Goldman Sachs, for one, argues that the rapid stock increase is actually completely justified
Okay.
because the underlying profit growth they expect from AI, it's not fleeting. They see it as powerful and sustained.
So this isn't just excitement over, future clicks.
Exactly. It's about fundamental structural changes, cost saving, efficiency gains.
And, crucially, it's about the health of the businesses themselves.
Precisely. Morgan Stanley really hammered this point home. They focused on the fundamentals. The corporate foundation today is it's so much stronger than what we had in 1999. They looked at the top 500 U.S. companies. The median cash flow is roughly triple what it was during the dot-com bubble.
Wow.
And corporate margins are way more robust now. These are companies generating actual cash today to fund their AI spending tomorrow. They aren't just burning VC money.
That strong balance sheet argument makes a lot of sense, but the bears have some serious firepower, too.
Yeah.
I mean, they're citing major institutions, the Bank of England, the head of the IMF, Kristalina Georgieva.
And they've issued explicit warnings about a potential sharp correction.
They believe the bubble risk is real.
And if it bursts, it could stunt global economic growth. And their concern isn't just about valuation multiples, it's about how this boom is being financed.
Okay.
Analysts are getting more and more worried about circular deals fueling the frenzy, especially in the private AI space.
Circular deals sounds a bit technical. Can you break down what that risk actually means for, say, the average person listening?
Yeah, sure. Think of it this way. In a healthy market, company A grows by selling things to the public or to other, unrelated businesses. Right. Circular financing is. It's more like a web. Company A invests in Company B, which then uses that cash to buy services or equity from Company A.
Ah, so the money just goes around in a circle.
Exactly. The revenue numbers look fantastic, but the real sustainable customer demand might be artificially inflated because the cash is just cycling between a few big players. It creates an echo chamber.
And that makes the sheer scale of the debt being used even more alarming.
Absolutely. The estimates for just the infrastructure debt are staggering. The debt used to fund data centers, the physical foundation for all this, it could exceed $1 trillion by 2028.
$1 trillion.
And that money is being lent today on the assumption that AI use is going to explode in the next 3 years. If it slows down, that massive leveraged debt is going to unwind painfully.
And right at the center of all this is, of course, NVIDIA.
Of course.
Its trajectory has been almost vertical. It hit $4 trillion in market value back in July, then jumped to $5 trillion just 3 months later in October. That kind of rapid ascent demands perfection, right?
It does. And we just saw what happens when perfection isn't met. We had those disappointing quarterly reports from major AI players like Oracle and Broadcom.
And it immediately weighed on the whole tech sector.
The whole sector. It just shows the market is hypersensitive. Investors are ready to punish any sign that the AI profit train won't live up to those dizzying expectations.
So if the market leaders are showing signs of sensitivity and maybe inflated expectations, where is the money rotating to? And that brings us to our second theme, looking beyond that narrow focus on the Magnificent Seven.
Yes. This is a major structural shift. We're seeing market momentum broaden out.
But it seems to be focusing on 3 very specific new cohorts.
That's right. We've all tracked the M7 for years, but now we have to talk about the emergence of the terrific 20, or T20, and the forgotten 50, the F50.
And this tells you the capital is searching for value, for diversification, outside of that handful of huge AI names.
Let's look closer at the T20 first. This group includes mega caps across tech, finance, industrials, energy.
So we're talking about names like JP Morgan, Visa, ExxonMobil, Goldman Sachs.
Exactly. And what's remarkable is that their stock returns have actually eclipsed the Magnificent Seven by about 12% so far this year.
But the T20 is where the valuation paradox really lives, isn't it?
It is. They're market darlings, but the performance doesn't quite seem to justify the stock price momentum.
What do you mean?
Well, despite massive stock gains, about 60% over the last 2 years, their actual contribution to S&P 500 profits has been falling.
Really?
Yeah, it's down to 15% now. It was almost 20% a decade ago.
That seems like a massive red flag. If their profits are shrinking relative to the index, but their stocks are soaring, is the market just being irrational?
It suggests the market is pricing them as beneficiaries of the second wave of AI, the companies that will adopt the tech to boost efficiency. But it also means this cohort is heavily reliant on optimism.
So the true value opportunity, in many analysts' eyes, lies somewhere else.
In the forgotten 50, the F50.
This is where you get profitability meeting deep undervaluation. We're talking high-quality, profitable firms like Eli Lilly, HubSpot, Mercado Libre.
Right, and their valuation multiples have fallen to just 2/3 of their 10-year average.
Which is incredible when you put it in context.
You have to, because these companies have delivered staggering growth, nearly 200% profit growth over the last 5 years.
So these are not struggling value stocks.
Not at all. They are growth engines that are priced like they're in trouble.
Yeah.
And that disconnect is why the cohort is so attractive.
And the undeniable example of this shift is Eli Lilly.
And the absolute huge shift underway in healthcare because of the GLP-1 drugs for obesity.
It's a generational change.
It is. Eli Lilly's drug, tirzepatide, it is Zepbound and Mounjaro, it became the world's best-selling drug in Q3, generated $10.1 billion.
Just to put that in perspective for you, it topped Merck's cancer powerhouse, Keytruda.
Keytruda made $8.1 billion. The demand signal here is just overwhelming. This is a structural change in how society treats metabolic health.
And the market is pricing in even more growth because the research suggests GLP-1s aren't just for weight loss and diabetes.
Not even close. We're seeing expansion into these huge adjacent conditions, addiction, arthritis, even immunity deficiency. The potential market is still expanding.
Which makes that F50 valuation all the more compelling.
And this shift isn't just about pharma. It's about how companies are managing their transition to an AI-defined future.
Like Tesla.
Look at Tesla. They're being very explicit about it. They're scaling their core hardware business today, cars, energy, but they're telling the market to expect future profit acceleration to come from AI software fleet services.
So FSD version 14, the robotaxi service,
Yeah.
Optimus production starting in 2026.
It's the bridge between the old and the new economy. Sell the physical thing today, but bet the real money, the real margin, is in the software tomorrow.
Okay, let's shift our attention now from corporate strategy back to the foundational economy. We talked about the uncertainty because of the U.S. data lag, but the research we analyzed provides a powerful, often overlooked indicator, one that might give you an 11-month head start on understanding the future job market.
Right. We need to talk about the business formation statistics, specifically high-propensity business applications, or HBA.
And what are those exactly?
These are applications sent to the IRS that have a high likelihood of becoming actual employer businesses, companies that will hire people.
This is the real aha moment for forecasting, isn't it? Why should you care so much about this specific piece of data?
Because the research confirms that growth in HBA strongly leads growth in non-farm employment.
Okay.
By a massive 11 months.
11 months. That is an incredibly long lead time.
It is. I mean, to compare, an indicator like retail sales only leads by about 4 months. 11 months gives you a full business planning cycle to see what's coming in the labor market.
So looking back, how useful would this data have been during, say, a crisis?
Incredibly useful. The data series wasn't widely tracked back then, but the retrospective data shows that HBA started to decline substantially before and during the early months of the Great Recession.
So it was signaling that hiring conditions were getting worse nearly a year before the job losses really hit full stride.
A full year. And its predictive power isn't just anecdotal, it's statistically proven.
How so?
Well, in simple terms, if you take HBA out of sophisticated forecasting models,
Hmm.
the error in predicting future employment shoots up, especially during economic recoveries. It's like trying to navigate a ship in the fog without your radar.
And we should probably clarify the difference between these high-propensity applications and the other ones.
Absolutely, because that distinction is key. Total business applications is the big number, but it includes non-employer applications or NHBA.
So sole proprietorships, side hustles.
Exactly. And while NHBA growth exploded after the Great Recession, lots of people starting gig work, HBA growth, the future employer businesses was relatively flat.
That's why HBA is the signal for future job creation.
It's the indispensable leading signal. NHBA reflects something entirely different.
Okay, moving now to the global macro landscape. Central banks are scrambling to react. Let's start with the U.S.
The U.S. context is complicated. The Fed cut rates 3 times this year, but they were effectively hawkish cuts.
What does that mean? A hawkish cut.
They were signaling that while they needed to ease things a bit, borrowing costs were unlikely to drop much further, especially since CPI inflation was actually accelerating, hitting 3% in September.
And the bond market reacted to that signal pretty quickly.
It did. Despite the short-term rate cuts, the yield curve has sharply steepened since mid-September. Yields on the 3-year note and longer have all gone up.
Which suggests the bond market isn't expecting aggressive rate cuts in 2026.
Right. It's pricing in persistent inflation or maybe stronger long-term growth that requires higher rates for longer.
And overseas, today's data from China is crucial.
Very. We've seen releases on industrial production, retail sales, fixed asset investment. Markets are watching to see if industrial production accelerated toward that 5% consensus. A strong number would confirm that the country is pulling itself out of those deflationary pressures.
Then we have this trifecta of central bank decisions this week.
A very busy week.
Starting with the Bank of England. They're expected to deliver a quarter-point cut, right? Down to 3.75%.
That's the expectation. Meanwhile, the European Central Bank is widely expected to hold the line, keep the deposit rate steady at 2%.
But the medium-term outlook for the Eurozone is changing.
Dramatically. Germany's announced fiscal expansion plans up to €1 trillion over the next decade. That's expected to seriously reduce the risk of secular stagnation in the bloc.
Which is already pushing up longer-term rates.
The 10-year EUR swap rate is heading toward 3% in 2026. It's a fundamental change.
But the one everyone is watching is the Bank of Japan.
It commands the most attention globally. The markets are pricing in nearly an 80% probability of a rate increase this week.
From 0.5% to 0.75.
It would be their first policy rate hike since January, and it signals a really pivotal moment.
That's a monumental shift.
It is. The BOJ is pivoting away from years of extreme accommodation, mostly because they're worried about the weak yen and importing inflation. This hike, if it happens, marks the definitive end of the world's longest experiment with 0 and negative interest rates.
And that has huge implications for global capital flows. The carry trade.
The whole thing.
You know, speaking of that extreme policy, we should briefly touch on negative interest rate policy, or NIRP. What we learned from it.
The historical evidence is mixed, and it raises a fascinating question about the limits of what central banks can do.
So what worked and what didn't?
Well, NIRP generally succeeded in pushing down the entire yield curve short and long-term rates. That was one goal. But its impact on actually stimulating bank lending was empirically disappointing because of something called the reversal interest rate mechanism.
And what does that mean for the average person?
It means that when rates drop too low, especially into negative territory, it squeezes the profitability of banks. And that reduction in profitability sometimes made banks less willing to extend new loans.
Defeating the entire purpose of the stimulus.
Exactly. It's an example of monetary policy just hitting the limits of its effectiveness.
Wow. Synthesizing all of that leaves us with 2 incredibly powerful defining themes for the market right now.
It does. On one hand, you have this rapid AI-driven technological transformation. It's fundamentally shifting market momentum from the original Magnificent Seven to the more diverse and maybe more fundamentally sound T20 and F50 cohorts.
And on the other hand, you have these huge structural shifts in macroeconomic policy. The U.S. bond market is signaling persistent inflation by steepening. The Bank of Japan is making this historic pivot.
And we now have this high-propensity business application data as a reliable 11-month proxy for future job growth, cutting through all that U.S. data confusion.
So here's the final provocative thought for you to chew on as you process this data-packed week.
If AI productivity gains potentially weigh on hiring, allowing new businesses to do far more work with fewer people while still boosting economic growth, how should you recalibrate your interpretation of that highly predictive HBA data?
Are these new businesses hiring fewer people per application than their historical counterparts?
Yeah.
Is the very definition of a likely employer changing in the age of AI? Something to consider as you look for those structural signals in the weeks ahead. Thanks for diving deep with us.
We'll catch you on the next deep dive.